As of the latest market close on Friday, May 29, 2026 at 4 p.m. Eastern Time, Nvidia stock finished the week trading at exactly $211.14 per share, marking an intraday drop of 1.45% during the session. While the broader market indices put up a mixed performance, the slight sell-off in this particular semiconductor giant pulled its massive market capitalization down to roughly $5.11 trillion. This slight downturn over the final trading hours of May came despite an intraday peak of $217.85 earlier in the session, showing that institutional traders and casual retail investors are actively wrestling over where the absolute ceiling lies for this corporate powerhouse. The immediate reality that completely catches the market off guard right now isn't the daily drop of a few dollars, but rather a hidden structural shift inside the global technology supply chain. Everyone assumes that software sales and large-scale cloud companies are the sole source of fuel keeping the semiconductor fire burning. But the massive, unheralded development keeping the underlying demand intact is the aggressive rise of independent domestic infrastructure setups globally. Countries are building localized cloud architectures to protect internal digital sovereignty, ensuring that the backlog of unfilled orders remains packed to the brim for months to come, regardless of whether domestic tech conglomerates pause their local spending. The common expectation among anyone utilizing a modern individual brokerage or checking regular updates on their phone is that this business is simply riding a generic tech wave that must eventually run out of gas. People look at the historical multi-trillion-dollar valuation expansion and naturally assume that the company is overextended, trading purely on hype and sentiment. The contrarian take to carefully consider over your morning coffee is that the financial fundamentals are actually keeping pace with the stock price appreciation far better than the skeptics want to admit. When you pull up a detailed analysis tool or look at the hard figures, the current trailing price-to-earnings ratio is sitting around 32, a figure that is remarkably grounded for a company growing its fundamental revenue at double-digit rates every single quarter. Looking closely at the recent price action, the daily swings tell a story of immense consolidation following the blockbuster first quarter fiscal 2027 earnings report delivered just over a week ago. On the actual day of earnings, the company absolutely shattered Wall Street expectations by putting up a record-breaking $81.6 billion in revenue, which was an 85% surge compared to the same period last year. Even more impressive was the net profit, which skyrocketed over 210% to land at $58.3 billion. When traders look at these numbers across online investing applications, they see a massive wave of capital flowing directly to the bottom line, backed by an incredibly robust gross profit margin that continues to hold steady at 75%. The sheer trading volume during the latest sessions, which regularly exceeds 280 million shares a single day, underscores the massive tug of war happening behind the scenes. Institutional asset managers are rebalancing their portfolios, absorbing retail selling whenever the price drops toward the critical support zones near $195. There is a deep underlying demand from institutions that missed the early stages of this asset expansion, and they are using any minor macroeconomic pullback or interest rate anxiety to lock in long-term positions. This intense institutional accumulation provides a hard floor for the price, making a deep systemic correction less likely than traditional market bears suggest. Comment below how many shares of Nvidia stock you currently hold in your portfolio, and whether you are buying more or trimming your position at these levels. It will be fascinating to see where our community stands on this asset. When assessing sector momentum, the hardware space remains a clear leader, though it is facing short-term pressure from constraints that have nothing to do with chip design. The ultimate friction point today isn't the ability to construct logic architectures, but rather the massive physical limitations of global power grids and electrical infrastructure. Tech giants can order tens of billions of dollars in advanced chips, but if they cannot secure the hundreds of megawatts of electricity required to power the new facilities, those chips sit in warehouse facilities. This energy constraint is a massive macroeconomic factor that is beginning to dictate the velocity of deployments and could temporarily slow down the blistering revenue growth rate later this year. To understand the core of the business model, we have to look past the financial spreadsheets at what the corporation actually does. At its heart, the firm designs highly specialized graphics processing hardware and deep computing architecture that forms the fundamental base layer of modern high-performance computation. Their primary profit driver is the massive data center business unit, which hauled in a staggering $75.2 billion in the latest single quarter alone, making up over 90% of total corporate revenue. They do not manufacture the physical silicon themselves. Instead, they rely on advanced packaging foundries abroad, allowing them to remain an asset-light design house with unparalleled corporate efficiency metrics. The legacy components of the business, such as consumer gaming graphics cards and professional visualization tools, now serve as stable secondary pillars rather than primary growth catalysts. The gaming division contributed a modest $3.5 billion to the recent quarterly figures, reflecting a typical seasonal slowdown after the winter holidays. Meanwhile, their growing automotive computing segment is slowly ticking upward, laying the groundwork for future revenue diversification when autonomous transport systems eventually reach widespread commercial viability over the next decade. Looking toward the immediate future outlook, the upcoming quarter will be defined by how cleanly the organization handles its generational hardware transition. Management issued extraordinarily strong guidance for the next quarter, projecting revenue of roughly $90 billion, which signals that customer demand is not showing any immediate signs of slowing down. The market is hyper-focused on the operational ramp of the new Blackwell hardware architecture, alongside early hints regarding the next-generation architecture slated for late 2026. If the production yields roll out smoothly without supply chain hiccups, the reality will likely blow past the conservative estimates currently built into analyst projections. However, the risk profile must not be completely ignored by anyone engaged in online investing or managing their own capital allocations. The business faces a total lack of revenue from the Chinese market due to strict export controls, meaning the organization has to execute flawlessly across the rest of the world to maintain its momentum. Additionally, the company's board recently approved an eye-popping $80 billion stock buyback program and raised the quarterly cash dividend to 25 cents per share, a move clearly intended to reward shareholders and maintain a premium valuation even if top-line revenue growth eventually hits a natural law of large number slowdown. When you weigh the long-term opportunities against the structural risks, the contrast between expectations and reality becomes completely clear. The prevailing public narrative is that the stock is a volatile, speculative bet driven entirely by short-term excitement over automation and machine learning. The reality, as evidenced by the structural data, is a company operating with historical profitability, immense pricing power, and an aggressive capital return program that anchors its long-term corporate value. While macroeconomic pressures and power grid bottlenecks will cause short-term trading volatility, the underlying computing infrastructure shift ensures that this semiconductor giant remains a central powerhouse of the modern technological world. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.